Hey, happy Monday. Let's trade dollar, let's trade yen, let's trade gold, let's trade oil. Anything else? Let's go! Hey, let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Never gonna get it, 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 never get it. Never take the risk. Something like that, I don't know. So, good morning. Hello, my name is Wayne McDonald. I am the Chief FX Market Strategist for Traders Way. Thank you very much for being a client. Thank you for being here. Thank you to Forex.Today for hosting us here at the Forex.Today YouTube channel. So, what are we going to do today? Gold and oil, that's fine. Yens, dollars, Swissies maybe. Has Theresa May been fired yet? Pretty soon, that's coming up. Has Trump been impeached yet? You're like, oh, you know what? Yeah, that ain't gonna happen. So anyways, that's funny, huh? So, Molnar said, hey, no Russian collusion. No obstruction of justice. So now we're going to have more investigations, more trials. They'll get them. They'll get them somehow. They'll keep trying. Nobody wants to govern anymore, I guess. Everything's a political vendetta. But anyways. So the markets are going to move. That's really nice. The world is still moving toward the Fed never raising interest rates again. Moving closer and closer into Japan's lost generation. So that's what's going on. We had a bit of an inversion on Friday, but this all goes back to Wednesday when Powell said they're never going to raise interest rates. In fact, what's happened more like on Friday where you saw a big drop in interest rates, or in this case, yields, someone might say, well, why did that happen? Okay? Why did that happen, right, Brooke? Why did that happen? Now, first of all, let's go back. I did prepare you for yen strength. Unbelievable yen strength up to now. Unbelievable. There's a huge drop at the beginning of March, then a huge drop in the middle of March. I prepared you for weeks and months for that. Okay, great. So on Friday, we had another massive move. I'm not sure if you understand what it is, so I just want to make sure it's discussed. So we go back to Wednesday. Jerome Powell says the Federal Reserve Bank of the United States of America is not going to raise interest rates in 2019. So people think about it. Then there's this horrific German news. Their economy sucks and the rest of Europe sucks. And we got this Brexit problem. Everything seems to suck. That's a technical word, by the way. We economists use it just amongst other economists, but I'm bringing you in. So everything's pretty gloomy, right? So what should you do with your money? You have $1 billion. What should you do? Well, the other thing that Powell said, if he's not raising interest rates, then he's also saying the interest rate you can get now is the highest you're going to be able to get for a very long time. Am I on early? What time is it? No, it's 7:30, 7:38. Okay, so you have to kind of reinterpret the market's response to what Powell said. So Powell basically said, look, interest rates aren't going up any further, so whatever interest rate you can get now is going to be the highest you're going to be able to get. Morning, Daniel. So what is the interpretation of then what happened? And Brooke is pointing it out here. Brooke says 39% priced in a rate cut. And that's what it is. And boy, those investors that bought the 10-year T-note 6 months ago at 3.2, holy smokes, do they look good, huh? Well, anyways, investors decided on Friday that the Fed's going to cut interest rates now, which is, you know, fuel to the fire, so to speak, where we go from a situation where the interest rate you get now is going to be the highest you're going to get in a bit, but then maybe by the end of the year, interest rates will fall even further. So you got to get what you got to get yours now, because it should go up in value. Now, take the whole interest rate. So if interest rates go down, what is actually happening to make the interest rate go down? So you have to flip the whole thing upside down and say, what's actually happening is a rally in bonds. Okay? To get the yield down, investors have to buy and drive up prices. So it's not necessarily yield, it's that if you buy a bond, like actually buy it, its value, not yield now, just the price. Its price is likely to go up. Okay? Now, especially as more and more people think the Fed might raise interest rates in the future, that signals, if you buy the bond now, just the anticipation of interest rates falling in December pushes the price of the asset you bought. So let's say you bought an asset. Here's a royalty check from Wiley. Right? It's a piece of paper. It's an asset. This could be a mortgage, a piece of paper. This could be a standby letter of credit. This could be, I don't know, it's just an asset, right? So here's a bond, let's say. So I buy a bond. I hold this piece of paper, and my analysis tells me I can sell this piece of paper for more money in the future. That's it. Its asset goes up. Now, it's still a piece of paper. But in this case, when you're looking at a bond, there's two things. You're getting an income stream, a cash flow, right? So there's finance. But then as you look at a market point of view, the actual price that someone will pay you for that cash flow in the future is going up. So you just buy it like any other asset. That's it. You just buy it. You just buy it, and in the future, it'll be worth more. So that's kind of what's happening, in my opinion. It's not the big signal of depression that you've probably read about, that the inverted yield curve points to a recession. That is true, and we did talk about this maybe 6 months ago and again a year ago. That in of itself is true, but that's like kindergarten economics. That's like big yellow crayon economics, right? Okay, that rule is true, but not in this situation. Okay, so what's actually happening is that the Fed just gave us a new price. Powell said he's not going to raise interest rates this year. Okay, did we know that before? What were we talking about before? 6 months ago, the Fed was going to raise 1, 2, maybe 3 times. So a certain thing happens. Okay? Then it's like, oh my gosh, they'll only raise 1 time. Repricing. Then the Fed comes out again and says, no. We're not going to raise 3 times. We're not going to raise 1 time. We've stopped raising. things need to adjust again because these things matter. They change the value of little pieces of paper, bonds and stuff, right? Changes the price, well, or value. It's like you live in your house didn't change from last month to this month unless you put a new roof on or something, but you can wake up in the morning and your house made you money. The value of the piece of paper that says you own this house goes up, and then you can sell it to someone. Sure, you can put a new roof or paint it or somehow change the intrinsic value, but the street value goes up and down, right? So anyways, when Powell comes out and says these things, it changes the street value of these things. Literally, the price goes up or down. So now the market is interpreting what's going on and saying, you know what? Not only are they not going to raise interest rates 3 times, because remember, when the market thought they were going to raise 3 times, that makes things change value. In this case, bonds might fall, the yields might rise or whatever, right? And then we learn it's not 3, it's 1. Everything changes in value. It's not 1, they're done. Everything has to change in value. And now what we've learned is the market thinks, and of course it's its interpretation of the facts, it thinks the Fed will actually cut interest rates, and that changes valuations again. Does it signal the end of the economy? There's more to it than that. But that is one component. But do you remember? Well, actually, let me ask you this, and hopefully the lag isn't too much. How many people have heard my long-winded story about yield curve analysis and the shoe store that has to borrow money to buy inventory, and then they sell the inventory, and then they take the revenue, and then they pay back the bank for their loan for the inventory, then they have to pay rent on the building, they have to pay their employees, they have to pay for the power and all this kind of stuff, and at the end, right, after all of that, there should be some sort of profit left over for the owners of the company, right? So there's a 20 or 30 minute version of that. I don't want to do that one. That's the 30-second version. But are we in a situation where the cost of doing business is so high? And by cost of doing business, I mean rent is so high, insurance is so high, borrowing cost is so high, and employee costs, wages are so high, you just cannot run a profitable business in the United States of America. How many people think we're in that situation right now? That's your interpretation. All those things together, nobody can run a profitable business. Okay? If that's where you think we are right now, then the inverted yield curve definitely means somewhere between 6 and 18 months, the whole market's coming down. If you don't think that's quite right, then put yourself in a different situation, interpretation. You say, okay, well, we don't have all those things. Interest rates are not too high. Wages are not too high. Rents are not too high. Okay? So what does the inverted yield curve mean? Well, it means the bond market is all messed up and it's not your normal, by normal, I mean textbook market. And there's other things going on at play. Again, sort of like when the Fed manipulated the market directly. Well, they always do. That's what they do. But I mean, like quantitative easing, they became the market. Well, that's not usual. In fact, it's never happened before, right? Okay, Alex is not too expensive yet and stuff. So then you have to say, well, there's a bond market, and that's just one thing. So what is it, the Bureau of Economic Analysis? Is that BEA? Or is it the other one? Who does a leading indicator index? Anyways, if you go and Google like leading indicator index, they look at, I don't know, 7 or 8 or 9 things to determine the economy. and one of them is a yield curve. Okay? Jimbo, don't say things like big bubble's going to burst. Say things like, well, if you look at the leading indicator index, 7 of the 9 economic data points that they track point to a recession. That's right. We don't need hyperbole, so to speak. That's what you read in the paper and stuff, and that may even be your opinion. That's fine. But let's keep it to like economic facts, right? And that's why I'm trying to say with the inverted yield curve, you might be reading that it's the end of the world, a recession's on its way, we're all going to live in caves again. No. Yes, an inverted yield curve is not a good thing. Yes, it is a standard normal market predictor, but you have to go beyond. Like, you don't buy or sell something because the MACD told you. You don't buy or sell something because the stochastics told you. You don't buy or sell your entire stock portfolio because you saw an inverted yield curve and you read. It's more like, how did we get to the inverted yield curve, and how is that related to a potential recession? Oh, okay. I'm sorry, Jimbo. I can only talk and watch the chat over there, so I apologize. Okay, so are we in an economic situation where American businesses cannot profit even? See, and here's the thing: the inverted yield curve, when all those things all those things I just talked about hit, where you're a shoe salesman, you're selling shoes like crazy, and when you're done collecting all the money, your same store sales are way up, you're having a good year sales wise, revenue's way up, and then you go through net operating income's negative and all this, and then you go through all your other stuff, and cost after financing, you're actually losing money. You're selling as many shoes as you could possibly stock, yet you're losing money. And by the way, I went shoe shopping this weekend with my family. It was a madhouse. Madhouse. I went to 3 car dealerships. They're selling cars as fast as they can do the paperwork. I talked to one of the guys, he's like, they're selling 20 cars a day. This is like Mercedes and BMW, right? They're selling like $50,000 and $100,000 cars. They're selling 20 a day. They just can't keep up. People come in like, I'll take that one, I'll take that one, and just boom, it's crazy. One of the big dog at Bloomberg, what's his name? Tom Keene. He went on vacation for the last week in Jamaica. And the first thing he said this morning was that they were there. The whole entire economy is based on tourism, and it's all Americans flying. And he says it's crazy. It's a madhouse. The economy is booming. He said it's not just rich Americans, it's the whole, right? The whole stratosphere of the economy, right? From poor people to middle income to middle class to upper class. They're all in Jamaica. They're all partying. They're all spending their money. Hotels are expensive. Drinks are expensive. Food's expensive. Going out on a boat is expensive. And you can't even find a place on the beach to sit down. You can't find a seat at the bar to buy a drink. Ho! So, are we in a situation where America is about to go in recession? Yeah, well, maybe we have to worry about that. And yes, an inverted yield curve you have to worry about. But people are buying cars, right? I went to 3 dealerships. I went into one, right? There was people everywhere. And they're all buying, right? They're all in their little booths and they're all doing the paperwork, and salespeople are going, and the girl at the front, she's even doing things. I walk in and I'm like, hey man, right? Hey, you cannot, there's no one even to help me. And he's like, hey, you need something? You know, there's not even enough people to help me. Holy crap. So are we about to go into recession? Maybe, but it kind of feels like we're not. So just I don't know. Be careful is all I'm saying. Do your analysis, right? Be an economist. Don't listen to what you read in the paper. That's an excellent t-shirt. I got to get one of those. Okay? Infinite Solutions is what's your interpretation of the inverted yield curve? Dude, I just talked about it for 10 minutes. You must be joking. So anyways, let's move on.com. The Fiat, no. You know, there's a lot of those Maseratis everywhere. I looked at a bunch of them. But no, I bought an M. But it's not for me. I bought it for my wife. So I'm just trying to help out Germany, you know what I mean? All right, so let's move on.com. Well, Kevin, yeah, well, Kevin says he sees the auto industry collapsing, and that might be true. Like, you think of it like at some point, you know, we're not even going to own cars. It's like you don't even wear watches anymore, right? So will all that go away and stuff? Yeah. And will we do ride sharing and stuff? Yeah, maybe. The thing is, there's only 2 ride sharing companies in the United States, and Uber and Lyft. And, you know, listening to some people talk about their interpretation of Lyft's upcoming IPO, they're like, oh, it's never going to work. It's never going to work. They're not even profitable. I'm like, well, it's a huge industry. Everybody uses it, and there's only 2 players, right? Like, hey, there's enough, you know, there's enough room in America where you can have 2 and you can invest. But anyways, the point being, maybe if you interpret, Kevin, that they're selling those cars and not making money, and that they're just paying to keep the lights on, paying to keep the, you know, selling cars to simply pay their salespeople. Yeah, you know, and when was a salesperson, you know, a car salesman ever rich, right? Right. I didn't see car salesmen going around and like, hey, do you got the 7 Series? They might be selling it, right? So car salesmen have never been rich. But I'm telling you, so I went to the same BMW dealership twice. I went a week ago, right? There's this whole area of cars I looked at. I went back on the weekend to buy, and they cleared out the lot. Like there were, like the first 7 was gone, the second 7 was gone, the 5s were gone. They moved a bunch of other things. I mean, the X1s, the X3s, the X5s, they're moving, like they're selling these things. It's like, it was almost like a new parking lot. Only recognized like three or 4 cars. They sold all these cars over the weekend, right? So, in just 1 week. So they are selling, and somebody's buying them. And then I'm going in to buy my car, and then like my neighbor's over there, the Yale guy. I'm like, oh my God, what are you doing here? And he's like, yeah, I want to buy an X5. I'm like, oh my God, like, all right, hey, we're high-fiving. Like, it's crazy. Like, it's insanity. Then I'm trying to buy shoes, and the place was a madhouse. No kidding. My wife is in line, and there was like 17 moms in front of her all buying shoes, like for their kids. I'm like, oh my God, in line. So anyways, okay. Oh, and here's one other thing. They're like, do you want to finance it? I'm like, no, pay cash. He's like, I'll give you 1.9%. I'm like, really? 1.9%. Like, okay, I'll finance that. He's like, you just have to fill out the piece of paper. And by the way, true story, I'm like, no, I don't want to fill out the paper. He's like, I'll do it for you. I'm like, sure. So he filled out all the paperwork for me, submitted it. They're like, yes, not a problem, just done. It was done in like, I don't know, 8 minutes. They're like, yeah, we'll finance you 1.9%. 1.9%. But maybe that's what it is. Everyone's financing and stuff. But I'm like, dude, I can take that money and I can make 1.9% in the market a year. You know, like, of course it's APR, but whatever. It was crazy. So the way to look at that, it's like, how do you interpret the credit market? So the credit market is the bond market, right? So that's how all of this can get financed. Like BMW can go to the market, issue a bond, collect a whole bunch of money from the bond, use the money to then hand out the financing, or they can give out the financing and then sell the financing or whatever, right? But it's form of credit. So one of the reasons the housing market was so bad in 2007, 2008, and even probably 2009 is that even if you found a house and it was 30% below the old market value, right? So it's $1 million house, now they want 700,000. People would go in to the bank and like, I can buy this $1 million house for 700,000. They're like, no, there's no money. We're not lending. Okay, that's a frozen market, right? So even if you get a good deal, you can't go to the right. There wasn't any credit. And that's why, by the way, the rich get richer, right? So I bought my house in the worst part of the financial crisis and nobody could get credit. And the bank, when I made my first offer, they were insulted. Insulted. I came back a year later, made a lower offer, and they were thanking me. But, right? Because the house was owned by a bank. So anyway, but because nobody had credit. I bought my AMG 55 from a dealer, and he was about to lose his house. He already lost his car lot and all that kind of stuff. He said he had like 6 people come out to try to buy the house. They all, or the car. Nobody can get financing, especially for a car, because it's not even a real asset, right? So, I paid cash. I paid pennies, right? So, like when you have cash, when there's no credit, you're king, right? Everybody knows that story. So now you go to the BMW dealership. They're selling them as fast as they can. There's people everywhere. They're all buying, and then you're like, "You want $75,000? Sign this piece of paper. Boom. We'll give it to you for cheap." You know, it's like, as an economist, you say the market is not frozen, it's liquid. There's money available. BMW doesn't have a problem giving you money. They give you practically free money, right? I'm going off. Well, I'm trying not to. Okay. Let me reframe this. Okay. Thank you, Brooke. Though, going back, I read in the newspaper that this inverted yield curve on Friday meant it was the end of the world. We're going into recession. It says it's a sign that 6 to 12 months from now, the economy is going to crash. This is what I'm reading. And it might be true. I'm trying to say, as economists now, as you go through your economy, try to interpret what's happening. Are there buyers? Are there sellers? What are the prices like? Is there liquidity in the credit market? Because if there's no credit market, you can't buy houses, you can't buy cars, that kind of stuff. Well, if you can't buy a house, even if it's a deal, there's something seriously wrong, and prices are going to crash, and people are going to lose jobs because now companies can't borrow. Remember General Electric couldn't even borrow money to keep the lights on. Usually they have overnight loans, weekly loans, monthly loans for cash flow and stuff, right? General Electric couldn't even get financing for just cash flow, like just really simple stuff. The market was dead, all right? Are we in a situation like that now? No, because the market hasn't crashed. What are the leading indicators that the market is about to crash? You can, let's say you can get financing, but you have to pay more money for it, right? Yeah, see, Jim got 0 for 6 years. Nice, right? So, yeah. So it's like, how do you interpret what they say in the newspaper, right? Which may be right, but it might be wrong. How do you interpret what you read in the newspaper, and how do you put that into action as far as what do you do with your net worth? What if you own a retirement account worth millions of dollars and you're reading the whole thing's about to crash? Right? What do you do? So the first thing is you have to say, well, the writer of the article probably doesn't give two hoots about your retirement account. Only you do. So you have to say, is that true? Do I see this? Right? If people were buying and it was all financing and financing was expensive, it's different than when financing's cheap, I suppose, right? I'd be more worried when nobody's buying BMWs anymore. Maybe it's a little late in the cycle, but like if I went to that same, let's say I go to the BMW and the Mercedes dealership. They're on the same street. They're not that far from here. Let's say in 6 months I go there and they're not moving the cars. I'd be more concerned. Okay? But like I said, even buying shoes was a madhouse. Alex is, so at what point does inflation come in? Well, this is where we're going, right, Alex? So what happens if prices start to go up? Prices go up for those shoes, prices go up for the rent, prices go up for the employees, prices go up for everything. What happens to borrowing costs? Borrowing costs go up. Why? There's inflation. The Fed raises interest rates to combat inflation, and then the prime rate goes up. So when you see an interest rate of 0 or 1.9, that's APR, above the prime rate. So if the prime rate goes from 1% to 2%, right, you have to pay 2% plus whatever they gave you, APR, okay? Well, we just learned not only is the Fed not going to raise interest rates for a very long time, they may even cut interest rates. You see what I mean? So that means there is no inflation. And that's kind of what we're looking at. The inverted yield curve, when inflation is high enough for the Fed to raise interest rates high enough that the borrowing cost for businesses is so high, it outstrips any profit margin. So the simple idea is, if after you pay all your costs of running a store, let's say, or whatever your business is, let's say you end up having a 5% profit margin, but to finance your business, you have to pay 5% or 6%, which means you're like, that's the concern, right? The BMW sells, well, it's actually Mercedes that told me they're selling 20 cars a day. So they're selling 20 Mercedes a day, but losing money doing it. When we're at that situation and you have an inverted yield curve, get the heck out. Okay? Are we there? I don't think so. Right? The Fed would be raising interest rates in a situation like that. Another thing to look at, and I think is actually a better indicator, is to look at rents, vacancies against an 8-year average. Okay? So when vacancies are falling and rents are going up, actually it's the other way around. When vacancies are rising and rents are rising, to me, that's the first, you're going to get that way before an inverted yield curve. One says it's not true that everything costs more than the last 2 years. Well, it's relative. Okay, so yes, more than 2 years, but like, let's say historically. Okay, you know what I mean? If I wanted to buy a house today, I'm sure the prices are higher than they were 5 years ago. but I might say I'm going to own it for 20 years. So even if we have a dip, or I would even anticipate 100% chance at some point over 20 years we'll have a dip, but by the time I want to retire in 20 years, I'll be able to sell it for a profit. So should I buy a house and stick renters in it and have the renters pay my mortgage for the next 20 years? Well, the first thing is, okay, if the price is high but not too high, I'm interested. Can I get a renter, and our rent's high enough that I can charge the renters enough money to pay my mortgage? And then third, the cost of my mortgage is going to come down to the interest rate. Can I lock in a low enough interest rate to keep my costs down enough so that the renters are going to cover the basis, and in 20 years I can dump the house and put the money in my bank account? If the answer to yes is all of that, I can make money. If the answer is houses have gone up 50%, so let's say it's California, houses have gone up 50%. Oh, and you need $2 million for a dog house, okay? And then you go to the bank and they're like, yeah, well, it's, this is a jumbo loan and problems, blah, 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 6.5%. Oh, what? Now things become a problem. So it might be a localized problem. Mortgages might be expensive in California. Everything's jumbo. Nobody has 20% down, all this kind of stuff. Okay, but that might not be indicative of the overall economy. All right, so let's move on though, right? I'm just taking you through the process of how to understand, because it comes down to how you trade, but how do you manage your portfolio? Right? Now, me personally, we went to cash on probably 60%. I moved to cash a bit early, but I got my reasons. I'm not saying there's a stock market crash yet or now or going to be, but I think a lot of things are fully valued, so we went to cash. Only on 60% of my entire net worth, but whatever. But now I got cash. Now I can buy stuff. Not the cars. That's just stuff. But if I want to buy a house, I could do that. Or if there is, let's say, between now and the end of the year, let's say there's another 20 or 30% decline in the stock market. Let's say 20% decline in the stock market. Well, then I can start buying then. Buy it back. You see what I mean? It's all a trade, guys. So again, I'm just sharing with you how you should probably do the analysis for your trades, do the analysis for your life. How do you interpret what you read in the newspaper or hear on television? Do you take it at face value or do you do the research? And I say, well, you should probably do the research. Okay. Okay. Move my stops. Okay. So anyways, let's start here. Euro yen on the left. How did we end last week? Oh, I need my drawing tool. Yeah, no, it's a lot. 60% is a lot. The other stuff we're in at good prices already. Think of it as profit taking. Yeah, I think so too, Kevin. All right, so what do we know? This is the monthly target. This was last week's target. So we know there's two reasons where bears will exit. So do we know if anyone's going to buy this? No. In fact, I would say this is the bearish sell Okay. So anyways, I bought it here. Off we go. So we'll see. Can't lose any money on it, so it's fine. I don't really care about it. But you know, the first plan A is here, right? This is the first sell price. This is the second sell price. Okay, and this is where I bought it. Brooke says reversal anytime soon. Yeah. I wouldn't call it reversal. I'd say entry. But yeah. But we know that it's going up here, right? So, you know, to put a little trade in, you know, to take a shot isn't a bad thing. But we do know if you want this to continue, let me change colors here. We know there's bears here and there's bears here. We know that. We just don't know if there's enough. Okay. That is the central pivot right there. Oh, okay, bro. Kiwi cat. Wow, huh? There's a true cross, Kiwi cat. So we'll just leave that one. We'll go to this one. This is similar but different. Okay. Here's your weekly M2. Okay. Here's last week's exit. Okay. Here's the monthly exit. So the thought process here is if, let's say, long and medium term bears exit, there might be a buying opportunity if you can get at or near the M2, and then here's the M2. That bulls might enter there. So I took a shot, can't lose money. Oh, Sam07 says, talking about yen, why did it get so strong in December? I didn't predict the October move, but I predicted January. Okay. So why? It was supposed to. I don't know. It's not a good it's not a good explanation, but it's just it's supposed to, so it did. The velocity was unpredictable, but everything else was absolutely, totally straightforward. All right, here's the beast. So you'll see that these didn't have long positions put on them because look at this. Remember those first two that we covered? We were at monthly targets. Look at this, not at monthly targets. Okay, so part of those other ones were sort of just the bearish exits. Someone might argue, well, this is more bullish because it's not down there. And I get that. That's fair. Okay. So let me get my drawing tool out and say, you know, what do we got here? You know, there's something going on, right? So if I was a buyer here, the first sort of target is going to be this top. Okay. But the plan would be something like this. So I would try to stay in April. If I was buyer now, I'd try to jam my stop and stay until April, fully knowing that I probably won't make money because it's still very high that it does something like this. You know, there's still Brexit risk and all that. That's fine. Take a shot, right? Brooke says, go from a monthly point of view. Yeah, so I don't use monthly charts. So I know he's probably talking about something else, but I see no fundamentals reflecting this. I'm not a pure technician. I have to have fundamentals as well as technicals. I have to have seasonality as well as technicals. And it's all relative. So pound and yen today is not the same as pound yen 6 years ago, but on a monthly basis, you're looking back that far. Dude, it's not 2011, right? So, so I wouldn't interpret this as just price and time. That's me. Okay. So if you're a bear, this is, right? This is a good sell zone. If you're a bear, that's plan A. Here's your plan B, right? Yeah, okay, I'll get there, Brooke. It's not something I cover, but yeah, I'll do that. I mean, what's the logic though? Is it, are you buying oil or selling milk? Selling lactose. Emilio says, Wayne, did you predict the yen strength through price action or fundamentals? Fundamentals. Absolutely. I talked about it for months and months and months in advance. I'd say things like, it's coming up soon. It's coming back next week. Get ready, everybody, next week. Boom. And it happened. I didn't think it'd be that fast, but yeah, it's. How about March? Dude, I prepped you guys for weeks and weeks and weeks. Here it comes. Yen's going to get strong. Yen's going to get strong. Yen's going to get strong. Boom! Yen's strong. Well, what else am I supposed to do? And I'd even ask, does anyone know why the yen's going to get strong? And everyone would type in Japanese repatriation, end of fiscal year end. Great. Good, so you know. So you're going to make a killing. Boom! Yen got strong. I'm assuming you made a killing. Right on, Brooke. Cool. I like that. That's good. I mean, those are the answers I like, right? I like that. Good. So anyways, on these smaller time frames, like, it's weird to, like, you have something here, you have something here, and we're here. Right? And like, I know someone's going to buy it here. That's an easy bull entry. But I also know, like, let's say here's an easy bear entry. I see a lower low. I see a higher high. So how am I supposed to know which one's going to make money? Well, first of all, I'd never know which one's going to make money. But how about this? What's the trend? Okay. And that's, if, again, let's not focus on like being right, being wrong, how much money you make or how many pips you make. Just like always boil things down to like basic analysis. What's going on here? What's the trend? If you can't figure that out, that increases your risk. The risk of losing money. If it's obvious, right? Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 down, down, buy. Up, up, up. It reduces your risk. It's just less risk. Okay? So you might, this is why we start on like 4-hour charts. Okay? But here I see a lower low and a higher high. Let's get rid of the outliers. So let's agree that this is a bottom. Let's agree that this is a top. What did we do this month? Nothing. Look what we did this month. We had an entry. We had an M2 entry. We're supposed to be up here. It's an inside month. So does that look like easy money? No. No, it does not look like easy money. So anyways. Oops, let's put this. All right. Yeah, Emilio, I thought I answered your question about that, right? And it was yen. So yeah, the yen move is absolutely straightforward. Sam says, I saw an interview you had on FX Street 2016. You were talking about correlation between dairy prices and kiwi. Yeah, I like that. Can you explain that a little? Oh, when dairy prices go up, the New Zealand dollar goes up. When prices go down, the New Zealand. Why? Well, it has to do with import-export. They're an exporting nation. And the percentage of dairy exports for New Zealand is high relative to their other exports. Some people look at it as a China play. Some people think it's more related to Australia than China. But like they don't export any of their dairy products to United States. So maybe it's an Asia play, right? So anyways, go to the Fonterra dairy auction website. There's great information there about dairy auction prices. They come out every 2 weeks. And for whatever reason, either the dairy prices follow the New Zealand economy or the New Zealand economy follows dairy prices. Can't really be sure, right? Correlation, not causation. So anyways, that's that. It's just, that's what correlation is. They move the same way, maybe for completely separate reasons, we don't know, but it seems that there is a relationship. Okay, and it's just that they're selling it for foreign money, right? Well, no, foreign money has to come into New Zealand to buy the dairy. So that pushes the value of the New Zealand dollar up as dairy prices go up. A foreigner has to pay more local currency, right? More New Zealand dollars for the same amount of dairy. So therefore it pushes up, right? But it's an interesting fact. Yeah, Banda, yeah, pivots work great. Pivots work great in the futures market, absolutely. Well, they come from the futures market. Okay, Banda? Pivot points come from the futures market. So yes, they're going to work. Thank you, Jim. Yeah, so I don't know if you guys are getting this type of macroeconomic or even just pure economic information anywhere. I don't know if you believe the sky's falling stuff that you read in the newspaper, but it would be appreciated if you find our conversation today interesting and maybe even informative. Would you be so kind as to do a like? Oh, I'm not going to tell you my moves, Caddy. That's between me, my wife, and God. Nothing's going to blast next. We're moving into a part of seasonality where typically, so you have a move like this, you have a move like this, and then sort of now between these Fed meetings, right? So you got the Mar to June. So it'll kind of quiet out, then it'll probably fizzle around again. And then after June, it's VIX is going to go way low, right? So, you know, one of the money wells that happens is VIX drops very, very low. And sort of the free money play is you buy the VIX. And it's going to pop in the third week of August. So you buy it in July. Make a pop there. And then flip over. Commodities will rally. So there's a couple of other things like, okay, so this was predictable. This is the false rally I predicted. Then here's the March drop, which also has been predicted. So how about the unpredictable stuff? Okay, so the stock market basically is double top like we talked about. And then let's say it's kind of fizzling around and we're rebalancing portfolios. And Trump and Xi, you know, the United States and China do a trade deal. Boom, just like that, snap. Also, right, so trade deal is, I'd say the biggest unknown now, trade deal. If that happens, this goes up irregardless of seasonality. That's not seasonal, that's new information, right? Is it true that Germany is doing a stimulus package? Is that true? If so, it's going to be the smallest, most boring stimulus package ever created by any government ever worried about their economy. They'll say, hey, we're pumping in like 40 or 50 euro into this economy. Boom! But anyways, that's interesting. That could push the stock market up. Is it true that France is cutting taxes because of the riots in their streets? Is that true? When was the last time France cut taxes? What was the tax rate during the age of chivalry? 92% went to, well, not to the King of France, to the King of Burgundy. The King of Burgundy was way wealthier than the King of France. But anyways, so France cutting taxes, Germany popping in a couple of euros into their economy. Interesting plays. You know, my dark humor tells me it's not nearly enough, but like just the whole idea of France cutting taxes is unheard of. And a German stimulus is funny, right? I mean, like, put it this way. The entire global economy fell into the toilet. We almost went into the end of capitalism as we know it. And Germany's response was to raise taxes and cut government spending. What? Because that is going to like revive the economy. So like if Germany really did, I don't have the details. A bird whispered in my ear, but if that's true, what do they do? And it probably can't be that much. But I think what's happening is they look at what Trump did to, and cutting taxes, for example. Boom, it put another big figure on the stock market. So, anyways, so we'll see what these things do. But that might be good for euro. That could raise the stock market not only in Europe, but everywhere around the world, because if Europe can finally kind of save itself, because remember, Europe is choking on its own blood, but only for 10 years, right? So at some point, if we can get Europe not choking on its own blood, I don't know, maybe they'll buy a Ford Fusion or something. I don't know. But maybe it's good for everybody, right? Because there are trading partners. So that's good for everybody. And then, of course, a China-Trump deal, the two largest economies in the world, so to speak. And by the way, Germany's the third largest exporter in the world. So if we can fix Germany, if we can fix China, and if we can fix the United States, there's nobody left. Right? Canada, Australia, right? All of them will only recover if those three economies recover. So anyways, there we go. Those are the big unknowns that could rally the stock market up. But what I expect, let's say March falls a little bit, and then by the end, well, we only have a week left, so let's say it goes up, and then we're going to have another big move down in April, but it's the same move. It's just some people pay taxes now, some people pay taxes later, and then it'll come back closer to May. And then there'll be a move sort of around the June NFP, and then back around the June Fed meeting, and then summer. But I'll tell you what, when I'm hanging out with Angela Merkel in May, I'll ask her, what's up? I said, what's up, Angie? And she'll give me the inside lowdown on the German economy. Jen asks a question about out-of-position swings. I tend not to want to do them at all. That's the first thing. If I look at it and it's out of position, I better have a pretty good reason to take on that risk, because it's more risk and it's less reward. Okay? So I better have a pretty good reason, like a good technical setup. I'm very confident, or already got one or two moves on it. So I'll put a half size on it or something like that. Because typically what happens in an out of position setup is you're going to hit your target early. There isn't one on here, but anyways. So let's say it was up here out of position. It'll hit the target early and probably counter trend. So if you're out of position, you're going to get from here to here and then face a collapse. So I try to tell myself, how about this? I try to tell myself that my trading, my income is based on a year's worth of trading, not on a day's, not on a week, not on a month. And so in a situation where I have, let's say, a weekly swing that's out of position, do I take it? No, I probably don't need it, unless something else justifies taking it, right? Because it's less risk, or it's more risk and less reward. Do I really need to add to it? Am I really that aggressive, or am I that desperate? I don't know. Okay, let's talk about Turkey, and then I don't know what time it is. Yeah, I guess we got to go soon. Okay, we talked about, so what was it? About 8 months ago, the Turkish lira collapsed, and I went through great detail, I think about 3 times, around that period to explain what happened to Turkey. And the problem with Turkey, or let's say the Turkish problem, has to do with that they don't have any foreign exchange reserves. Okay? And I told you this means they have to go into the foreign exchange market, dump their lira to buy dollars and euros, and then pay their debts. Now, if they had the dollars and euros in their vault because they did more business, right, then it wouldn't matter because they already have the dollars and the euros. They don't have dollars and euros in their vaults, but they borrow dollars and euros. So now they got to go to the open market, exchange their lira to acquire these foreign exchange currencies, or these foreign currencies, and pay back their foreign debt. And I said every time they come up for bond payments, they're going to have to do it again and again and again. But the problem is, the last time you did it, you lowered the value of the lira, so now you need to sell even more lira to get more foreign currency to pay off the loans. So every time you do it, it's worse. So Turkey fell by 5% on Friday. Why? They were probably preparing to pay debt. You see what I mean? So you could probably bank on it if you can figure out when big debt payments are due. You could probably time the shorting of your lira, especially if you're going to hedge if you're Turkish. Does that make sense? They just don't hold the physical dollars and euros in their vaults, and that's a problem. So the solution for Turkey is to export. I have several Turkish friends, wonderful people. I've had people in my family die on Turkish soil. I've never been to Turkey. I would love to go. So I really don't know much. So that's the caveat. But the Turkish economy lacks foreign exchange. That means they don't export. Turkey needs to participate in the global market if they want to avert this problem in the future, or stop borrowing money from foreign banks. But I don't think that's going to happen, nor would that help the economy. Because if you can borrow money at 2% versus 12%, I'd recommend the 2%. But whatever you do, you should export. Make something and sell it to a foreigner so that they give you dollars and they give you euros. Okay? Cool. So I guess we'll leave it at that. I didn't mean to go fundy on you guys today, but I did mean to make sure that you understand clearly the inverted yield curve that you might be reading about, and how to make your own fundamental decisions on whether you should cut and run or invest or run away, or, you know, like just make your own decisions. Because at some point, you're going to be a professional money manager, and you're going to have a client that comes in to sit with you and say, hey, I read about the inverted yield curve, and I've heard in the past that that's a sign, a clear sign of recession. Should I be worried? And I say, you know what, that's a wonderful question. And that's true. An inverted yield curve very often does point to a recession on its way. But let's go through why it's a leading indicator for a recession, and then we'll apply that knowledge to what the economy is like now. to our current situation, and perhaps together we can develop a plan. And your client will say, "Thank you very much. I appreciate that. I really do." Cool. So, peace on earth. May the pips be with you. May your profits be above average. Thank you very much for being a client of Trader's Way. And I will see you tomorrow and Wednesday and Thursday and Friday. Please subscribe. Please watch all the other videos on YouTube associated with my work. There's about 4,000. Please give me a thumbs up. Please leave comments. Please leave comments. Please leave comments. Even just a thanks is highly, highly appreciated. Visit tradersway.com and open an account today. They make this available to you. Make sure you pay it back, huh? Cheers.